Okay, so let's dive in. When you think meta platforms, you probably still think Facebook first, right? Instagram, WhatsApp.
Sure, those are the big ones, definitely.
But, the companies evolve so much. It's not just social media anymore. They even changed their name, signaling this huge push into, well, new frontiers.
That's right.
They've poured, really significant resources into things like AI and, of course, the metaverse.
Yeah, massive bets. And that's really what we want to unpack today. While everyone's sort of captivated by these grand visions, our deep dive is going to, well, pull back the curtain a bit.
On the financial reality.
Exactly. The financial reality behind that ambitious push, especially focusing on their Reality Labs division. We've got some numbers that might genuinely surprise you, and we need to talk about what they imply for Meta's future.
Right. So our mission today is pretty clear. We've sifted through a load of financial reports, expert analysis, and we're going to pull out the key takeaways for you. We really want to understand what these huge investments in Reality Labs actually mean for Meta. And maybe more broadly, what it tells us about how these giant tech companies handle risk, handle innovation.
Well, it's a classic big tech balancing act.
Well, look at the really impressive numbers that have frankly hidden some pretty big issues for a while now, and discuss what could happen down the line.
Definitely.
But the thing that really jumped out at me from the reports was just the sheer scale of the losses, specifically within Reality Labs. Could you maybe walk us through those figures? Because this division, their metaverse arm, it's become, well, let's just say a substantial money pit.
Indeed. It's not just the total number, though, that's staggering. It's the trend. Ever since they started breaking out this segment back in 2021, the operating losses from Reality Labs have blown past $60 billion.
$60 billion.
Yeah. So in 2021, Reality Labs lost $10.2 billion.
Oh.
Okay. Then it jumped to $13.7 billion in 2022.
Oof.
Then $16.1 billion in 2023. And it hit $17.7 billion just last year in 2024.
Wow. It's accelerating.
It is. And even just the first quarter of this year, 2025, they tacked on another $4.2 billion to that loss pile.
Yeah.
So grand total, we're looking at $62 billion.
Yeah.
And like you said, the really noteworthy thing is these losses keep increasing year after year.
$62 billion. Just to put that in perspective for people, that's more than the annual GDP of countries like Luxembourg or Costa Rica. It's almost, well, it's hard to even wrap your head around that amount of money for one division.
It really is.
So how do you square that? How do you reconcile Meta's, seemingly really strong overall profits with these just massive ongoing losses? What's the secret sauce that's let them sustain this?
Well, the secret sauce, if you want to call it that, it's Meta's core business. It's a family of apps segment, Facebook, Instagram, WhatsApp.
Very traditional stuff.
Exactly. That part of the business has been incredibly profitable. Just look at the first 3 months of 2025. Meta's overall profits grew by a whopping 45% to $16.6 billion.
1 quarter.
In 1 quarter. And the family of apps alone generated an operating profit of nearly $21.8 billion in that same period.
So Family of Apps makes $21.8 billion. Reality Labs loses $4.2 billion. Okay.
Precisely. That massive profit has just easily swallowed the losses from Reality Labs. It's effectively masked the problem, at least from a bottom line perspective for many investors. It's the kind of spending that, would make most CFOs break out in a cold sweat.
I bet.
But Meta's core business has just been this incredible shock absorber.
Okay.
And this really brings us to the core insight from our sources. How long can that masking effect actually last?
Right, because it can't go on forever.
Probably not. There are 2 main concerns highlighted in the analysis we looked at. The first one, the most obvious one, is just the inherent vulnerability of Meta's revenue stream. It's overwhelmingly fueled by advertising.
Ad spending.
Right. And if economic conditions slow down, what's one of the first things companies cut back on?
Advertising budgets. Always.
That's right. Exactly. So when that ad growth rate slows and Meta's overall earnings don't look quite so spectacular, you can bet more attention is going to shift to that, let's call it troubling, Reality Labs performance.
Yeah, the spotlight turns harsh.
Investors might suddenly become much more demanding. They'll want to see a tangible payoff from that massive $62 billion investment. And if they don't see it, well, that could easily lead to a sharp drop in the share price.
Yeah, that makes perfect sense. The ad market can be fickle, can be volatile. Now, some people might argue, okay, these multi-billion-dollar bets, that's just the cost of doing business at the cutting edge. It's the price of true innovation in tech.
Sure, it's the argument.
But what does our deep dive suggest about that perspective, especially when you look at sort of the historical context of Meta's other big bets. It feels like Meta has developed a bit of a habit of, jumping from one hot trend to the next.
That's absolutely right. And that's the second big concern, and maybe a deeper one. It points to a pattern of what some analysts are actually calling poor asset allocation.
Okay, explain that.
Well, Meta has consistently shown this tendency to chase the latest hot trend.
Yeah.
Remember when the Metaverse was all anyone could talk about?
Oh, yeah. Huge pivot, name change, everything.
Exactly. They went all in talking that up. Then, seemingly out of nowhere, they launched Threads to compete directly with Twitter, or X.
Right, the Twitter killer that sort of fizzled a bit.
It had its moment. And now, their focus seems to have aggressively shifted again, this time to AI.
The new thing.
The new thing. The company just recently announced it's rolling out a standalone Meta AI app, clearly designed to compete head-to-head with ChatGPT.
Taking on OpenAI directly.
Directly. And it's not just building things in-house. They've already made a substantial investment, $14.3 billion, into a company called Scale AI.
14 billion, just like that.
Yep. And reports suggest they're actively scouting other AI companies for even more investment. So at a time when there are already, growing whispers about maybe overspending in the AI sector, and with so many really formidable competitors already established,
Google, Microsoft, OpenAI.
this pattern does suggest Meta might once again be getting overly aggressive in chasing the current hot tech trend, maybe without a clear path to profitability for that specific venture.
It's interesting, though, because despite all these underlying issues, these massive bets we're talking about, shares of Meta platforms are actually up. They were up about 19% this year as of late June. Investors still seem pretty bullish overall.
Yeah, the market seems willing to give them the benefit of the doubt for now.
And you look at its valuation, maybe 27 times trailing earnings its profits over the last 12 months. Some might even say the stock still looks, modestly priced compared to some other tech giants.
Perhaps.
On the surface.
But this deep dive really does put a spotlight on the potential for, tougher times ahead, doesn't it? Especially if that economic slowdown happens and the ad revenues start to buckle.
Absolutely. My biggest concern, and it echoes the author's concern in the source material, really revolves around this aggressive spending pattern. It could absolutely backfire down the road.
How so? Well, think about it. Right now, the market is, around all-time highs. Investor sentiment is generally positive, optimistic, but that might not last. Factors like potential tariffs, global trade tensions, geopolitical issues, these things could change the mood pretty quickly.
And Meta's vulnerable there.
Highly vulnerable. Its business is so dependent on a strong global ad market. If that buckles, the stock could really be due for a steep correction.
Yeah.
People might suddenly look very differently at that $62 billion hole.
Right.
Plus, let's not forget, there's still that significant antitrust case involving Instagram and WhatsApp just looming over Meta. If that actually results in some kind of forced breakup, well, that could drastically change its entire business model and its future growth potential.
That's a huge shadow, yeah. Okay, so maybe let's try and summarize the core tension we've really explored today. Meta's current performance, particularly that incredibly strong family of apps segment, has very successfully masked these truly staggering operating losses from Reality Labs.
Staggering is the right word.
Those losses, they've now cumulatively topped $60 billion since 2021. Actually, $62 billion if you count the first quarter of this year. And the really striking part is that the losses have been increasing each year.
Getting worse, not better, so far. And this brings us right back to those two key concerns that really should give any investor pause. First, that vulnerability, the reliance on ad revenue that could dry up in a recession. And second, this emerging pattern of what looks like potentially poor asset allocation. Chasing trends. We saw it with the Metaverse hype, then the quick pivot to Threads, and now these incredibly aggressive multi-billion-dollar pushes into AI.
Right, including that standalone Meta AI app meant to rival ChatGPT and that huge $14.3 billion investment in Scale AI.
Exactly. So the author's cautionary stance on the stock becomes pretty understandable, especially citing the current high market valuation, those potential global trade headwinds, and of course that ever-present antitrust threat hanging over Instagram and WhatsApp.
So here's a final thought to leave you with, building on everything we've discussed. Given Meta's absolutely colossal investments first in the metaverse, and now this equally ambitious, perhaps even more expensive leap into AI, What does this deep dive really suggest to you about the nature of innovation and risk-taking at the very, very top level of global tech?
Mm.
How do these incredibly bold, almost existential bets balance against the fundamental need for sustainable profitability? And maybe looking forward, how might that inherent tension reshape not just Meta, but the entire tech industry as we know it?